guys, Chad Larson with MLD Wealth. It's December and rolling into the last month of the year. It's a chance to kind of look back and start to plan to look forward into what 2023 will bring. Obviously, 2022 is marred by a myriad of volatile events, the conflict in Russia, and seemingly, an event that we could call, the Great Tightening, as the Fed has reacted. Central banks around the world really have reacted to, rising inflation near 40-year highs and trying to cool that by quantitative tightening or the raising of interest rates. We'll get into a little bit of that, and I actually usually generally try to do a over the Christmas holidays armchair read of a look back and more so a look forward. So I just really want to spend the time here in December talking about what we see into the end of the year. Lots of key terms, throughout the year. As we've been publishing monthly, we're transitioning some of the content here to a podcast as well. So hopefully that gets approved and on your various platform systems. As many of you like to see my face, many of you could get away with that. Everyone said I had a voice for radio, but a face for radio as well. Here we go. Listen, everyone's talking about, recession. We've been saying inflation, and how to position capital in and around that, and how we've been able to navigate such volatile marketplaces. Listen, stocks typically rally in December, but this year investors have some caution. If you go back to November, October, September, we've been talking about the fall, how the markets, could seemingly pull back in that regard. And then on the go forward basis, we would look for the market to create a bottom, but that the bottom would generally only be signaled by, a pivot within the Fed to, stop aggressively raising interest rates, and so that the market can start to see the other side of that steepening curve and allow money to flow a little bit easier. Again, consumers and businesses can't spend money they don't have, and nor spend money they can't afford to borrow. But here we are in September or December, and as I said before, the stocks typically rally. Listen, investors hoping for a year-end to rally to bring the stock market gains up after a punishing year. Generally have history on their side, as U.S. equities traditionally rally during the month of December, but we're remaining skeptical of forecasting this rise. I think the market's got a little bit optimistic through the month of October or November. We saw a near 8 to 10% bounce off the bottom in the S&P. And these gains would be welcomed by many investors after seeing the S&P still off minus over 16% for the year. Still weighing on the markets has been the U.S. Federal Reserve's actions to aggressively tighten interest rates to fight inflation, as I mentioned. So again, December is going to be usually a good time for investors, but right now they're stuck because it's really the focus on rates that will cause the markets to go up and down in the short term. We've got another Fed meeting coming up here right away. The question this year is, will the Fed raise by this month will the Fed raise by 75 or 50 basis points, and whether or not there's any dovish or commentary that suggests the Fed will raise rates one or two more times next year and then call it quits. So we're really looking almost body language and commentary at this stage, just to see when the pain is going to be over. Again, December is generally a good month. There's a lot of fund managers, that have outperformed over the year, are buying stocks that have outperformed over the year to do a little bit of window dressing. They want their 13 Fs and their top 10 positions to look like they hold all their winners. So there's generally some of the best names will rally. So Santa Claus could bring some presents to traders that actually show up, over the holidays. But this year, again, the investors' focus has shifted to the Fed and at the pace at which it's going to continue to raise interest rates as it attempts to bring down inflation. Listen, investors tend to be optimistic going into the new year, but this is the Fed's market. They're used to a couple age-old sayings. The trend is your friend, and don't fight the Fed. But now it's the Fed isn't your friend, and don't fight the trend. So, when we look at consensus, investors are pricing in about a 75% chance that the Fed will raise rates at its December 14th meeting by 50 basis points to that target range of 4.5%, with the probability of a more jumbo 75 basis point move is at about 24%. And that's according to CME's FedWatch tool. So, minutes that were released that were curious from November 2nd meeting by the Fed showed that a substantial majority of policymakers agreed it's likely soon to be appropriate to slow the pace of interest rates, though Fed members believe that there's a significant uncertainty about that ultimate level of how high rates need to rise. Another outsized increase in rates could impede the more than 10% rally um, in the S&P since the start of October. That was largely fueled, like I said, on optimism and hopes that inflation had peaked from these 40-year highs and would allow the Fed to slow and eventually pause its the most aggressive rate hike we've seen since the 1970s. Um, Fed Chair Jerome Powell will speak on November 30th. He signaled that the central bank could shift to smaller rate hikes next month, but has also said rates would ultimately need to go higher than 4.6. That policymakers thought in September would be needed next year. So sharply reduced valuation for public and private firms is definitely a painful consequence of higher interest rates, and likely mean that the S&P could fall 9% over the next 3 months. So I do kind of within our thesis, I think the markets were a little over exuberant in October, November. We'll take it. We have beta exposure on, and we experienced and participated in that rally, but liquidity remains very high across core portfolios. Some things also, that we're weighing is, its potential, other reasons to have hope for this seasonal rally is an incredible amount of short selling has been covered. Nearly 30 billion in short positions since the start of the month, with the largest covering coming from consumer discretionary, healthcare, financials, and so that's great to see that shorts are, unwinding their positions. They're trimming their positions as the market rallies, as they're going to incur mark-to-market losses and possibly trimming positions in anticipation of a year-end rally. So, the painful double-digit decline in both U.S. stocks and bonds, meanwhile, have made a lot of asset classes more attractive. Things look pretty decent if you have a 1-year time horizon, but not without some potential significant volatility in the next quarter or two. One of the things I'm going to try to is having trouble posting some of these slides. So I'm going to talk to maybe pictures that you can't see. I'll try one more time here to put it up on the screen. We'll see how that goes. Now it's not going to work. I'll post them after, but we look past the year-end rally and really kind of discuss, why a recession, calling a recession is going to be so key, and to determining if October was a low or the low, because the markets have bounced back from October. So I've got 5 slides that I'll post up onto the website or attach to the send out. And for those listening on podcast, if you're a client, give us a call. If you're not, give us a call anyway. But it would be historically unique for the S&P 500 to bottom before a recession. So what we're saying is that, if we are going into a recession, which I think we are, I really don't see how a soft landing happens here. Then we haven't seen a low. It would be historically unique. Looking back all the way to 1957, and throughout the U.S. recession troughs, from the start date, how number of months that it took to get out of them, and looking at when the low was made during those recession troughs. There was only one instance where the S&P didn't make a low during the recession. So if we're going into a recession, the market hasn't seen its low, and I think that's further to the kind of the commentary that I gave earlier. Is there's maybe Santa Claus is going to bring some presents into the end of the year, which we'll happily enjoy. But I think there's going to be a rocky start into the new year. Corporate CEOs have done their best to batten the hatches and right size their businesses and cut costs. We're starting to see a lot of labor costs leak out of the market, as you would expect during a tightening period and rising interest rates. But we're not seeing we haven't started to see a lot of negative guidance or reduced out forward-looking statements and guidance from CEOs. I think everyone wants to get through this year, make their bonus, whatever's left of it on the table, and get forward. And I think pragmatically, you could see a number of companies kind of come forward with reduced guidance and cause some turbulence into the market in the first part. Recession outlook, looking yield curve inversions, historically going back to 1978, we've seen the percentage of U.S. Treasury yield curves that are inverted are over 55%. That's a level that signals a coming recession. There's one time in history where this hasn't happened, but yield curves are telling you that a recession is coming. Recession outlook, conference board leading indicators, again, a drop to the current levels in the LEI, the leading economic indicators, year over year, has indicated a recession. So, another data point saying this recession is coming in a more formal basis. Recession outlook, this is State Diffusion Index signaling 2023 recession. This is the Philly Fed 1 month State Coincidence Diffusion Index. That's a lot of jarble and jumble, but a drop below zero in the Philly Fed 1 month index has indicated the close proximity to a recession. So lots of things pointing to, I think, some obvious facts. Pivot outlook in a levered era, pivot not a pre-recession buy signal. If a recession is coming, the initial Fed rate cut has not been the time to buy. So we want to, with all of that being said, we look to say, that was a pretty negative kind of path that we just talked about. The stock market's a magical creature. It's something I always say we have the benefit of having future-looking glasses, albeit cloudy and muddy sometimes. But the minute we wake up in January, we get to look forward and even start talking about 2024 numbers. The minute we're in 2023, we start to, the net present value of future earnings and visibility from companies that do have strong visibility into their earnings pictures years out. It gives a higher weighting into, their valuations. So I think, regardless of what I talked about last month, I would have originally thought September that this fall and whoosh, would be that moment where we could go all in and deploy, because we'll get stocks seemingly get cheaper and cheaper by the day and still screen that on a recovery make a lot of sense for entry. But again, coincidentally or contradicting that is that a bottom is going to be continued to be found, but the bottom will be when the Fed starts to pivot the aggressiveness of their rate hikes. Last month, we also commented, Canada came out with a 50 basis point hike, and my comments were that, albeit we would love to see them kind of rip the Band-Aid off and get more aggressive and get this over with, you can't just throw a wet blanket on inflation. It needs to kind of stay here for a little bit longer, these higher rates, to kind of cool the economy down and the consumer, and then in the tank treads of disaster behind, the high interest rates rolling through town, is you're going to have a scenario where the consumer is going to be damaged, the homeowners, is up in the air. You're starting to see a lot of weakness across residential house prices, even seasonally adjusted. So there's a little bit more pain, but again, in these hallowed walls that we call an office, where we manage capital for private clients, I've always said the economic data will continue to get worse. And in fact, probably the news cycle of sentiment, it hasn't even started to peak being negative. But by then, the market will actually start to be surging, because there's a lagging effect to how it affects Main Street, how it affects the consumer. But that means once we're on the other side of this, the market is very quick to look forward through yeah, the other side of a quantitative tightening period. And I think, when we get into the latter parts of 2023, you're going to start to see yield curves normalize, and interest rates start to come down, and that should provide the fuel for the next surge and up leg of the market. So regardless if there's another 10% down from here, so be it. The reality is we're in the bottom part of the U. Whether there's a little bit more to go down and it chips along the bottom before it rallies up, or we are at a bottom and we chip along for the side and it goes up. Regardless, our outlook 1 year out is very positive. So maintaining a high degree of liquidity, maintaining a high degree of confidence and conviction in deployment strategies, and looking at what sectors will be overrepresented in client portfolios that will continue to do well in inflationary environment, but also be positioned for an accelerated growth out of the bottom. Some interesting tactical things we've done. This is kind of maybe leaving it to the end. Maybe some people will see this or don't. There's a position being brought on within the core portfolio in the Japanese yen. It's been absolutely brutalized against a surging US dollar basket. The US dollar basket won't hold forever. You've started to see it slip. And the yen, the yen's down almost 30% year to date. Kind of a value dumpster diver, looking at it as a bit of a haven currency. The Swiss franc is usually another currency that we would look at for recovery, but it hasn't moved as much. So a tactical position in the yen, and as well actually added a position in long bonds and duration. So avoided the calamity of being owning long bonds, because long bonds are down 25, 27% in some cases as the yield curves become inverted and interest rates have risen so much. That being said, when you have a year when 30-year treasuries are down, I could pull it up. I want to see. I think I entered the position. They were down almost 27% at that time. They've done really well. So the yen is up 6% this month. Long bonds, are up 6-7% this month. So you're starting to see some tactical shifts into the portfolios, deploying some cash prudently at a risk-adjusted basis, and starting to see some of those thematics that we've been very disciplined on be net contributors and adders to the performance of portfolios. Some unrest in China. People are finally standing up. People are a little perturbed. They're being locked down again, and so that's something we are watching. That caused a little bit of concern and panic into the oil markets this week. Obviously, we're overweight energy. It's been a strong contributor to bottom line performance across core portfolios, combating weakness in pretty much everything else. So some short-term weakness, but demand numbers came out 2 days ago, and but global oil consumption is at pre-pandemic levels. We're not magically flying around, on new technologies and hoverboards quite yet, much to the chagrin of environmentalists. Oil demand continues to be robust. Oil supplies, are dwindling, and net investment hasn't accelerated with the price of oil this year because of a lot of uncertainties in fiscal and political regimes that are kind of not liking the oil so much. They need it, but they don't want it. Kind of a catch-22. So a bit of a short-term weakness this month, but I think those trades will continue to bear fruit. Doing a lot of hard work, on the service side of the energy complex. Obviously, the commodity producers have done incredibly well, and there's a bit of a laggard effect as obviously capacity gets to get used up through increased activity down into drilling, but more so it takes time to start to push increased prices onto your consumers, especially off of a complete down cycle where service companies was apropos and just not on the table to pass costs on or increase service costs. But we're in a competitive environment now as drilling is picked up. So the service is something we're really looking at. There will be some, I think, just robust cash flows and earning surprises in that space. I don't want to continue to kind of blather on for the sake of blathering on. I just wanted to wish everyone a great December. For all our clients that are hiding down somewhere warm, I'm jealous. For all of those up here that are freezing, hopefully you get to enjoy some skiing through this month, and all the best to you and your families into the holidays. And look forward to speaking to you with you. Into the end of the year and into 2023. As always, if you have any questions, give myself or a member of the team a call, and have a wonderful day. Take care.